David, how are you?
I'm good, Dale. Sorry about the
I'm
delay.
sorry. Anyway, I forgot to email it to you. I got caught up in our discussions here. You want to use the camera today?
Yeah, let me see if I can get it. Hold on.
Okay. And then I'll share my screen and we'll go over what's happening in these markets.
Let's see. Uh, what isn't it?
That's just that little video thing. And
Yeah, I'm trying
you
to.
use your iPhone for all of these interviews, don't you?
Yeah, I do.
Yeah.
I'm for some reason I can't get the camera.
Okay. Well, that's fine. Okay. So we'll just talk about what's going on here in the markets, David. That's the main thing.
Sure.
Okay, so let's talk about the S&Ps. Last time I talked to you was at the Trader Summit in early April. And, I've been in these markets a long time. And, there are many occasions where I might be right long term, but short term early. And I think your expectations were, 42, 4,300 would hold. So my question to you is twofold. Do you think these are the lows, or will one more pop in yields? If there's a negative number, we'll get to that. And because the market took longer and corrected deeper, are you adjusting your final upside target, or is it the same?
Yeah. So, first of all, yeah, I don't think my target needs to be adjusted down,
Okay.
and certainly not up. I still am using 6,000 on the S&P as my target. Um, and for the Nasdaq, I'm still looking for 20,000, Dow 45,000. So those are big numbers. Yeah, you're right. I was thinking we'd probably see the correction take us down to 4,200 at the lows. When we broke that back in February, I guess,
Yeah.
it was pretty clear we were going below that. Yeah, I can see possible risk down to 34, 3,500. I don't really think you'll
Still.
see.
Yeah.
Yeah, I don't think you'll see 3,500. I actually think the lows are probably in, but I
Okay.
wouldn't rule that out. Obviously, it feels to be like we are very close. Everybody's expecting a higher CPI number tomorrow.
Right. The
Um,
White House
even yeah,
planted
even the
that
White
out
House.
there. Yeah.
Yeah, they're trying to basically prepare everybody. So who knows? I mean, I don't.
Okay.
I always say I don't really pay much attention to monthly releases. They're backward-looking releases, but it certainly helps going into the number to have expectations so low, meaning looking for higher inflation. Either way, whether CPI surprises on the downside or the upside, um, I think inflation has peaked. Obviously, CPI is not the number the Fed really pays attention to, and it's really not the true measure of inflation out there. So you're seeing plenty of leading indicators in the form of futures
Yeah.
telling you that not only is it rolling over, but it's rolling over hard. I mean,
Yeah,
oil is a matter of,
I saw a tweet of yours when we were up here, and you said that this could have been the day, and I think it was the day that wasn't it the day, and it happened on a news event that Europe was gonna ban Russian oil,
right,
and
right.
that was it, and we tagged this major support level and tried to bounce last week, but even the oil bulls, like my associate Steve Volge, think that we're going, 80-ish. Yeah, but the
Yeah, exactly.
formation,
Yeah, that's where I think the next stop is. What was pretty clear to me. People didn't pay much attention to the fact that we made our high on the day that Russia invaded Ukraine.
right,
So we went
right
to
here.
130 on a spike, and
Yeah,
then we spent 3 months filling in below that 130. And all I heard was talk of,
Yeah.
it was what I call leapfrog, lots of people saying 150 and others saying 200 and some saying, no, it'll even go higher than that. So it's pretty clear you had, the emotions in there for higher prices. And yet it was looking to me like what we were getting was, a lower
Failing rally.
high retest and then a
Yeah.
rollover. And that's exactly what we've had. Um, and the other thing that was pretty clear, and I called it, was I looked at XLE on a long-term chart, and it was, putting in a right shoulder on a very long-term chart, and it counts to, it was, got up, the right shoulder was in the low 90s. It got up to 93 or 4, I think, and rolled over hard. It looks to me, as I keep saying, in the bust, you're going to see oil down to 30. I think in the bust, you're going to see XLE down to 20. So again, look at where, every single institutional money manager that would come on CNBC or Bloomberg would say my favorite group is oil stocks. They're still undervalued. They're still very cheap. So it's
The
clear to me.
rotation, the rotation for this next rally, I'm sure they're going to come back into energy and think it's,
Right,
people
right,
will buy dips all the way down.
right.
But I believe that your preferred longs would be Russell, because you think we're entering, this is going to be a real speculative phase of the market if it turns into a melt up. So are you still in that camp that Russell will outperform the
Yeah,
rest of the
given
market?
given my targets, I think Russell has the most upside, but it's pretty much, I'd say it's also the Nasdaq, and it's pretty much across the board. People want to know, what sectors are going to outperform, and I said I can tell you what's going to underperform. I think it'll be the defensive sectors, and meaning staples, utilities,
Yeah.
and then obviously energy. But I also think, yes, semis I think will do well, even though they've been hit really hard in this correction.
Yeah.
I think miners will do well, even though they've been hit really hard. I think industrials will do fine. I think some of the early cyclicals like autos and housing will come back when the Fed pivots here. Um, so
Okay.
it's really it's a broad rally. You almost don't have to pick sectors because of the moves you're going to have in the S&P, the Nasdaq, the Dow, and certainly the Russell are going to be big.
Okay. So I look at
So
the Russell here and I see a 2 drive, and that implies there could be one more shot down for a 3. I'd be interested on one more drive in the RSI holding above 30 here. I also wanted to talk about, you have a lot of confidence in Powell. I've heard it in the interviews, and that, you've said Powell knows what he's doing, and
well,
he's going to.
I think you're a little behind on my commentary because
Oh, okay. All
I
right. So
started to,
the question then is, all right, was Powell more hawkish than you thought he was going to be 6 months ago? And that's part of the reason. So bring us up to date on Powell, your view of Powell now, 6
yeah,
months later.
I'd say since probably late April or May, I started saying Powell, I was very critical of Powell back in 2018, saying he was way over his head. He was learning on the job. He was
Yeah.
when he made that commentary about rate hikes are on autopilot, it showed his
Yeah.
inexperience. I was very critical then. In 2020, in response to the pandemic, he acted tremendously swiftly in unprecedented type of period, and did the right things to make sure we didn't just collapse. So I gave him a lot of credit and said he's learned a lot on the job. I think he's really stepped into his role. I then, back in late April, I think it was, after Bill Dudley's speech, and then I guess it was probably the May meeting when Powell kind of acknowledged that he was right on board with Dudley on this. We're targeting the stock market. It needs to go lower to tighten financial conditions. that showed me he knew, he was really behind the eight ball, didn't know what he was doing. And I became from then on, I've been saying lately that Powell is probably making, is probably going to make the biggest policy error in history.
If he
And
continues to tighten, David,
if
and
he, yeah,
then
if
do
he
you think,
continues to tighten, and my
okay,
my guess is what we're going to see. I do think we're going to see some sort of a pivot this summer. I don't know whether it's just a pause in rates. Certainly, initially it'll be a pause in rates, but I think he's not only causing a crack up here, causing a worldwide crack up. When you see Sri Lanka, when you see, um, you know, all the stresses and strains around the world,
what about
that
these
comes
bank
from a
runs in
Federal Reserve
China?
that doesn't, wait. That comes from a
Okay,
Federal Reserve that doesn't understand. It is causing a liquidity crisis everywhere. And it's so myopically focused on an inflation number that is, he was right initially. Some of it is transitory, not all of it, but some of it. And it is not, what he does not understand is the leads and lags. And this is typical of
yeah,
a Federal Reserve chairman, but
6 months to a year, right?
yep. So they're waiting for the reality of their policy to work. They want to see data release that comes out and says, okay, inflation's back down a lot. That's way late. You need to look at futures things. You need to look at things that are leading indicators, and he's looking backwards. So I am very critical of him right now. Now he can get back on board, but my guess is, and this is just a guess, that what I think we'll see is a pause this summer, and the market will get excited about that. Maybe more than a pause when they start realizing just how much the economy is decelerating and we're getting, financial problems. And it's not the market. Everybody thinks he targets the market, that he used to target the market. Is really the Fed's job is to target the economy and obviously take care of inflation. But he's ignoring the economy and ignoring all the signs. The things are heading south in a hurry. And frankly, what I think shows me his inexperience more than anything, and it's not just him, a lot of the street is like this. Um, the the failure to understand that we are in unprecedented times in terms of leverage in the global system.
Yeah.
And so an error made today that might not have caused the disaster it's going to cause today is going to cause a huge, crack up because leverage just exacerbates everything. He seems unaware of the risks, is what I'm saying.
Okay,
So
well, that would lead me to conclude that you probably have more conviction about the bust because of his overreaction and current actions based on lagging information from CPI that he's ensuring the bust comes later.
yeah,
The question is, how do we get a melt up? Oh, just one thing, Dave, I wanted your comment on it. Now,
sure,
he says he's another Volcker. Okay.
that's
Now,
scary.
Volcker did it twice. Remember,
Yeah,
when
it
we
was
were
a double
5 years
dip.
old
It
and
was a double
had
dip.
our ice cream cones
Yep,
and
yep.
Volcker tightened, then he stopped and then he did it again big time. Could
Yep.
that be the scenario that we have Powell
I
play
think
out here?
I think precisely. That's what I expect here is I do. That's why I say I think we'll get some sort of a pivot this summer that will ignite the melt up. And then because of Bill Dudley's speech, it's going to be still front and center on Powell's mind. Imagine if we see the S&P at 5,500 or 6,000, he's going to be saying, "Oh, I was wrong. I shouldn't have taken my foot off the brake." And he's going to come back probably with
Slam them.
more aggressive QT is my guess, along with
Okay.
maybe some hikes. But my read of the bond market, by the way, Dale, tells me that we've seen the highs in rates. I think we're going to see 2% or below by the end of the year on the 10-year. So that makes it hard for me to see that he's going to do a lot of rate hikes after this summer. I just don't think he's catching up now. So sure, we're going to get 75 in July, no question. And he could do another one after that. But I just don't, you're not going to see such a divergence between the 10-year and the overnight money that he's raising while 10 years telling him he should be cutting. So
Okay,
I
so you
I think it's
technically that
QT.
lines up. Technically, that lines up with your target. So this
Yep.
is like 50 bips. So 50 bips under here is about no, that's 70 bips. So it takes you down to 2%. Here's your 50-week moving average. And all we have to do is take out last week's low to activate that formation.
Yep.
And the
So
market's going to
I
like
think,
that.
yeah, and the only question I have on the 10 years, there's a gap up at 320. So could you get a spike on the CPI if you
Yeah,
could?
it'd be a right shoulder.
Yep. And I don't think there's much room beyond 320. So I think basically from here, it's very little upside on rates and a lot of downside. And of course, I keep saying that in the bust, and it won't be a straight line. They'll once we get to say 182%, you could have a little bit of a backup in rates before you go down again. But I do think that in the bust, you're going to see 0% 10-year and probably a negative 10-year. The 30-year, I think, can probably get down to a quarter or maybe a half. But so
let's talk about King Dollar then, which is something else that has surprised many, except the milkshake theory guys. Been looking for this, and here we are. I think the market needs a lower dollar because they're finally talking about earning translations of the strong dollar. David, do you think we're close now? Can a broken clock be right twice a day? We're near a high here, don't you think?
I'm probably the last guy with any credibility on the dollar because I was looking for it down all the way up. But yeah, I think we're very close. This is typical of a blow off, right? I mean, you got people talking 130 and higher, 120 and higher, and I think we're there. I don't know what day it's going to roll, but basically, and I'll get back to the dollar, but if you look across many markets, whether it be, the stock market, the bond market, the currencies, the metals, everything really lines up with a Fed pivot. When the Fed pivots, you're going to see all reversals. There's some big reversals in many, many markets. So the dollar's no different. I continue to say we're going to see something between 80 and 85 on the dollar. And that sounds crazy, but I think we're in a crazy time.
Yeah, you like the Aussie, David, and it's not a bad looking chart. It's held up much better than Euro. Because when you see, go ahead.
I think you're going to see 90 versus a dollar, 0.90 on the Aussie. So, and same with the Canadian, not as much. Canadian dollar looks maybe 95 from here, but that's, basically, I think it's again the sign that once the dollar rolls and rolls hard, you're going to see the commodity currencies come back into play.
In April, we were on different sides of the copper trade.
Yeah, well, copper's another one. Again, all of this,
they all go up together and down together. It's all one market, Dave, isn't it?
But it's also all tied in to again, Powell's missing the signals. All of these are signals that he's gone too far. When you have copper fall as sharply as it has fallen, is when you have oil falling like it is in the face of everything going on, when you have wheat falling sharply,
wheat too,
very sharply. When you have
how is that economically sensitive? It's not. It's just financialized.
Yeah, exactly. But it's also because of Ukraine. It has a global.
But it's the same chart as everything.
And we've seen, you and I having been around a long time. When deflation hits, or inflation hits, it hits all commodities. It doesn't.
But there's at least some differentiation between equities and commodities, and maybe the dollar and sectors. But it seems like the whole board, Dave, is like a balloon that when there's easier money, air is going in, and they're all going up, maybe different magnitudes. And when there's tightening, the balloon, the oxygen is sucked out and they all go down, just with different magnitudes and hardly any differentiation
Yep.
between asset classes. Have
Well,
you ever seen that before?
not to the extent we are now, but I think it really points to the fact that the Fed's policy is far more aggressive and wrong than any we've seen in a long time. I mean, it's I get it. I get why, it's easy to make the mistake, because you look at inflation and then you look at interest rates and say we have a long ways to go, or you look at markets up on stilts and you say, well, they can go down a lot more. So I can understand the Fed perspective like that, but that's why it takes somebody who really understands monetary policy and understands markets. And Powell does not. He does not understand that we're in a very different cycle because of leverage and because of everything that's going on in the last several years, particularly.
Maybe Kramer has to yell at him. They
Well,
just
yeah.
don't understand.
Yeah, right.
I'm gonna rant out of Kramer. Think that would do it?
I don't think so, but Powell, you mentioned before the Volcker comparison. Powell, made a comment in one of the last couple meetings, referring in a way to himself like a Volcker, kind of saying, I'd
right.
like to emulate Volcker. That scared the hell out of me.
Yeah.
Volcker was a very smart monetary person. He was a very long time central banker.
You know what his nickname was, Dave?
Powell's an attorney. They're very different people.
You know what Volcker's nickname was?
I can't remember.
The liquidator.
No, I mean, but what he did was correct back then. If Powell thinks he can do what he did then, again, if Volcker had the leverage we have today, and did what he did, we wouldn't be around to be talking about this now.
But it'd be Mad Maxville.
So I mean, that's the thing. Powell just doesn't have the full knowledge and perspective, and he should not be doing what he's doing. Now, I will take Bill Dudley to task. That speech he gave in April was the stupidest speech he could have given. I mean, the Federal Reserve should never be targeting the stock market. Stock market, you shouldn't be targeting, nor should be propping it up. But the stock market should be left of its own free will. It will discount things if you leave it alone, and it will go where it needs to go. To say we're going to get the stock market down because we know best. Remember Greenspan's rational exuberance? That was many years too early.
Yeah, I do. And also, someone made a point that just 2 percentage points in employment, say, went up to 5% from 3.
Yep.
Can you imagine all the support payments for people that are going to be unemployed? That there'll have to be some type of aid and rescue, and we're broke already. So,
I think you're going to see a lot more than 5% on unemployment because of what the bust is going to be. People don't realize that stuff can come fast and furious. People want to be able to project everything out. It doesn't work like that. So, once we get into the bust, I think you're going to see a lot of layoffs. But I think, again, labor is being distorted a lot by what's happened in the last 2.5 years in the pandemic. And look at savings, which was up at 35%. Has dropped down to below the norm, down to 4.4%.
They're using credit cards now.
And they're using credit cards. To have such a dramatic drop in savings, people are, when you go out to restaurants or you go to the dry cleaner or whatever, you see everywhere signs of help wanted, and you talk to the small business people and they say we can't get help. Or you go into Target and the inventory is laying around in the aisles because they don't have enough people. It's nobody's talking about it, but where are all the kids? Where are all the early?
Where are the Great Resignation? How are they paying their rent?
Yeah, so they paid because the government gave them all kinds of money, and they said, "Oh, this is great. I don't have to
But
work."
that
But
was
it's
gone a
catching up.
long time ago.
It's catching up now. Savings has really dropped, and so then they're stupid enough then to say, "Well, I don't want to work yet. I'm going to borrow on my credit card." That all is coming to a crashing end sometime soon because they should be out earning a living and they're not. And I don't hear anybody talking about that. Everybody acts like we have a tight job market. We have a tight
Yeah.
job market because people are choosing not to work. We've really changed uh, the focus in
Psyche.
this country, the psyche
Yeah.
in this country,
We were
and
known for the work ethic.
yeah, and it's not for the better, that's for sure.
No.
So there's a lot. I mean, there's a lot to be bearish about, and I am. What people don't realize is that we've put so many people on one side of the boat, bearish, that if you get a pivot, you're going to be amazed. That's the only reason I can call for this melt up. It's an extreme
They say
call.
the public is still long. They haven't
Yeah,
capitulated. Do you believe
yeah, I
that?
know. I don't totally believe that based on what I see on Twitter, but
Yeah. There are
yeah,
a lot of
because they're
people that are depressed.
yeah, I'm not sure. Certainly the AAII numbers, the
Yeah.
small investor numbers are pretty bearish. I mean, they're at historic levels generally. They bounce up and down week to week, but so I think bearishness is very high. Um, I want to get back to what I said on the S&P because I don't want to leave the wrong impression. I'm not
Okay.
saying we're going to 3,500. I'm saying that's a possibility. I think there's a better possibility that we've seen the lows and that we're just kind of filling in still, waiting on CPI, waiting on the Fed. But
Right.
I don't. There's a lot of reasons why when you look below the surface, this thing may not have a lot of downside. But I won't rule out 3,500. And no, that doesn't make me change my melt up. Everybody says, "Oh, if it goes, what level will it go to that you turn
Okay.
more bearish?" I'm pretty much convinced that sentiment is just so bearish right now that whether it's from here or from a little lower, there's a big leg up.
Google
What
looks
will
good. Google looks good over 24. It's going to give you 27 and then maybe new highs.
yeah what you're
Microsoft
already yeah
Microsoft looks okay. I don't think we're going to make a new low in Microsoft. So some of the mega caps look okay.
I think
They may
what
pull
you've
back,
had
but yeah.
what you've had is a huge correction in the over-owned big growth stocks, Amazon too, that I
Yeah.
think they've all pretty much bottomed and are beginning to be reaccumulated. And I do think those three in particular go to new highs and significant new highs. I don't know that Netflix is going to new highs.
No.
I don't know about Facebook
I like
or
that
Meta,
Google chart.
but Google, yeah, Google, Amazon, Microsoft, they look like they just had very stiff corrections because they were so so overowned in portfolios.
Yeah.
And that's the thing I do want to say too is people don't understand. I'm a macro strategist. What nobody ever talks about is what's discounted today. So people discount, and then they want to discount it again when you get another bad number. Then they want to discount it again when you get another bad number. At some point, you've discounted the scenario for the bears. At some point, having Amazon and Google and Facebook and Tesla, et cetera, come down so hard. We have discounted a lot. You hear a lot of talk about the upcoming earnings season, what we're in now, and how
Yeah.
the earnings,
There'll be revisions, downward
there's going to be
revisions.
big downward revisions, so we have to wait to get through that. Well, we've had big downward revisions in stock prices, so people do not understand. Stocks are looking out, a couple quarters. Yes, they can, if they get a number that they're surprised by, they can readjust again downward. But generally, we've had a huge reaction to this Fed tightening cycle to this earnings, earnings rolling over cycle. So I just think it's easy to, all you need is a Fed pivot, and you're going to have people looking over the trough and saying, hey, look what we can get in 2023 if the Fed's back at our, is at our back again instead of a headwind.
How long should this narrative play out and you get like a pause? Not right to an ease, but to a pause. Do you think the market will accomplish most of this to the upside in 6 months?
I think that's the possibility. I get locked into because people want me to, give them a time frame and stuff. What I will say is two things. One, I'm still saying 3 to 6 months from when the melt up starts. So let's say it starts this week. It could be over by the end of the year, but it's not so important whether it's 3 months, 6 months, or even 9 months. It's going to be a much steeper leg up than the last leg up, which was the March 2020 to the end of 21. So that was basically, when you do the count on that one was basically, 21 months. So this one could go 12 months, or it could go, but I think more likely, I think you're going to get the parabolic, so it really shortens it. That's why I can say it's unlikely to be 3 months. It could happen, but certainly 6 months is possible. But I'm not, it doesn't matter whether it's exactly that or whether it goes a couple months beyond that. The point is, it's going to be
the direction right.
Well, not just the direction, but I think the magnitude is going to be perhaps the biggest rally in history. And so, and that can still be the case, and the biggest and steepest rally, and that can still be the case whether it's 3 months, 6 months, or 9 months. And I'm not stretching my timeline. I don't have a timeline really. I still think it very well could be mostly, if not all, done by the end of the year. But I just want people to understand it's the steepness of this rally that makes it, I think, what I like to call stunning. I think it's going to be a very stunning period of time.
Okay.
And as you know, the way sentiment works right now, the majority of people are looking down when I think we're on the verge of something that we've never seen before in terms of magnitude of the rally. So that, that fits with what we've seen before. People are most bearish at the wrong time.
Okay, looking forward to seeing this comment streak across my screen, David. Really appreciate your level of conviction and your openness to, that no one.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.